Welcome back and welcome to the next lesson in this course on validating your business idea, where here we're going to be looking at the potential profitability of your business. So really, no matter what your business idea is or business goals, whether you want to create a brand or change the world or help your customers with all this cool stuff that you're thinking of doing, really your goal needs to be profitability, because without profits, your business doesn't last. And without your business lasting, you can't achieve your other goals. So this section is crucial to your success, and it's really important that you pay attention. And I'd definitely like to add a disclaimer up front to say that you should definitely be speaking to your accountant to do proper financial forecasts before going ahead with your business. However, this thought process will give you a clearer indication of the potential profitability of your idea. So let's jump right in. Basically, there's many different factors and variables that can affect your profitability on a month-to-month basis. But it can be summarized into three things. The three things being selling at a higher price, buying at a lower price, and then managing your costs so the costs don't eat into all of your gross profits. So let's jump in, and this video is going to look at the first two things: buying at a low price, selling at a high price. So let's firstly look at the idea of your selling price. If you already have a product or if your product already exists in the SA market, it makes it very easy for you to choose or decide what your pricing is going to be. The reason being, you need to match or better what your competitors are doing, because the nature of customers' ability to price check you versus your competitors is super easy with online. It's not like the good old days where if somebody wanted to compare a product price, they would need to go jump in their car, drive to one store, drive to the other store, check the prices, and then make a decision. Right now, well, you know this deal. You open up two tabs on your computer screen, you see what the price is there, what the price is there, and then make a decision. So your pricing, it needs to be super transparent. It needs to match or be better than your competitors. It can be higher if you can offer something that your competitors can't offer, and we'll circle back to that in a minute. So it's important, if you don't have your product readily available in South Africa, it's important to know that you can use a US dollar price as a base to figure out the rand price. But it's not just a simple process of taking that dollar price, timesing it out by the exchange rate and saying, well, that's what I'm going to sell it at. Because let's say, for example, we're looking at a product that's worth selling for $1,000. You times that out by the current exchange rate, 13 is always hovering between 13 and 15. Hopefully no more than that. But if you times it out, you're looking at a selling price of $1,000 equals maybe 15,000 Rand. But it's not going to be true. The rule of thumb is times about 20. So a $1,000 product in America becomes a 20,000 Rand product in South Africa. And it's important that you understand why, because your customers are going to phone you and they're going to ask you, why are you charging so much? Why are you making all this profits? Why is it unfair? And I've had many conversations like that, so I know the deal. And the explanation really circles down to two factors. The one is that shipping products from manufacturers, generally China, to America is super cheap, because of the amount of airplanes and ships moving back and forth across the Atlantic, Pacific. The economies of scales just means that it's far cheaper for them to have their products there. Whereas we're at the bottom tip of Africa, so getting stuck products here is very expensive, and we need to account for the shipping fees to return potential faulty products back to our supplier. So that's the first aspect. The other aspect is the tax and VAT portion of it. In America, the manufactured recommended selling price, as they call it, what we call the recommended retail price, their selling price doesn't include tax. What happens is there's different taxes for different states. So when somebody buys that product for $1,000 and they move to the checkout process, depending on which state they're in, the appropriate tax will be added to the cart. So South Africans look at the $1,000, they look at our 20,000 Rand price, and they think it's very out of balance. But our 20,000 Rand, our recommended retail price, does include our VAT rate. So it makes it seem that it's out of balance. But people need to understand that that's a difference. And customers can even go to that American site. They can add it to their cart, check it out, say deliver to South Africa, and they wouldn't see the tax, because if you're buying from out of country, the taxes don't apply. So customers really get confused by this quite a lot. But if they buy that $1,000 product and they get it shipped over to South Africa, when it comes through customs, they're going to get hit by 15% VAT. So that's unfortunate, and that's going to get them closer to the 20,000 Rand, which they would have paid, plus their shipping fees, and they then have to deal with any potential warranties, because we're not going to support their warranties locally if they've imported it themselves. They need to account for the fact that if something goes wrong, they need to ship it back to America. So circling up, it just means that there is a seemingly disproportionate price between the American retail price and the South African retail price. But now we understand how to get your rand price from the dollar price and how to explain to customers why the price seems out of balance when it's actually the correct way. So let's circle back to what I mentioned a minute ago about being able to sell at a higher price, because ultimately we want to increase our profits by selling at as high a price as possible, but keeping it in a level where we're not pricing ourselves out the market and we're not going to get any sales. So a great way to sell at a higher price using something unique that your competitors can't match is through using bundles. So what I mean by that is, if we take a GoPro camera, for example, and the GoPro sells for 5,000 Rand. So let's, in this example, say the gross profit margin on this camera is 25%. What we can do is we can look for any accessories that we can bundle with this product, and those accessories we want to have much higher margin, like 40-50% margin. We then bundle it all together and we show a bundle product to the customer where we say, the camera's 5 grand. The retail value of this bundle is 7 grand. So the retail prices of the camera plus the memory card plus the carry case plus the mount, that all, if you added all the selling prices, comes to 7,000 Rand. But now we're offering you a bundle discount. If you buy all of this together, we're going to do it for 6,250 Rand. So now the customer's getting a discount, but because the Rand margin on the accessories was so much higher, you can actually achieve a higher gross profit margin on the entire sale, because adding in those extra things and discounting it means that your Rand value margin is actually better for you. So it's a really cool way to offer great value to the customer and to achieve better profits yourself. And also, if you can be clever, you can use a product that your competitors can't get hold of. And then that gives you a unique advantage in the market. So definitely a cool way to be looking at how to increase your selling price. Because ultimately, as we've said, selling your profits at the end of the day are going to be affected by your selling price. And secondly, about how low you can buy the product for. So we're going to look at that next. Ultimately, if you're looking at buying a product, you need to see where you can source it at the absolute lowest cost. And let's keep in mind, we also need to find a reputable dealer who can give us good quality product. But don't just settle for the first supplier that you make contact with. If you're buying it locally, is that product with an exclusive importer? In which case you don't have a say. You got to deal with them. But if there's many importers, reach out to each one of them and see what their selling price to you is and who's giving the best rates. And then negotiate every opportunity you can. The other thing you can do is if it's a generic product or available overseas, go to Alibaba, speak to the American suppliers and see if you can get it in from there at a cheaper price. Because ultimately, every single percentage of your margin is super important. I can't emphasize that enough, because your margin is what drives the business. It's what keeps you alive. And if you can negotiate and fight for 1 extra percent, no matter how you get it, you've done well. And if your suppliers ring you up and say, hey, your profits are next month the prices are changing and your margin's going down, just battle them and fight with them. Like, if your margin's coming down, try and get a rebate somewhere else to get your margin back up. Just use every opportunity you can. Whenever you've got negotiating power, use that to try and get your margin higher and higher, because that is what's going to drive your business. So in this video, we've looked at, firstly, selling at a reasonable price, as high as you possibly can without pricing yourself out the market, and then buying at as low as humanly possible without compromising on the reputability and the product quality. In the next video, we're going to jump into that third aspect that I mentioned earlier about your costs, because the selling price less your cost price gives you your gross profit margin. That gross profit margin isn't your net profit margin. That's what is yet to be eroded by your costs, and that then achieves your net profits. So let's jump into the next video and see what costs we have to consider